Have you ever really thought about the numbers? The US government spends trillions of dollars a year. It's a figure so massive, it's kind of hard to wrap your head around. But here's the kicker. When taxes don't cover all of that spending, where does the rest of the money actually come from? Well, it's one of the single biggest financial operations on Earth, and we're going to break down exactly how it all works. Right, so we're not talking about just going to a bank and asking for a loan. This is something else entirely. This is about funding the whole US federal government through a system that's incredibly deliberate and, surprisingly fascinating. When the money going out is more than the money coming in, the government has to borrow. And the story of how it does that, well, that's really the story of how our entire global financial system is built. So who are the architects behind this whole massive operation? It's not some random, faceless committee. It's actually a very specific and dedicated team of debt managers right inside the US Treasury. And their job is, to put it mildly, critical. Yep, deep inside the US Treasury building, there's a specialized group called the Office of Debt Management. These are the folks on the front lines, and they have one of the most high-stakes jobs in all of finance, managing the nation's debt. Now, this team isn't just trying to find a good deal on any given day. They operate with a single, unwavering mission. You can think of it as their prime directive. It's a principle that guides every single decision they make about borrowing trillions of dollars. And this is it. This is the whole ballgame. Fund the government at the least cost to the taxpayer over time. Now, the most important words there are over time. See, this isn't about chasing the absolute lowest interest rate this week or this month. It's about playing the long game to guarantee financial stability and ultimately to save taxpayers' money for decades. So how do they actually pull this off? Well, it's a strategy with a few key parts. First, they create financial products that are basically rock solid, super high quality. This helps them attract investors from all over the world. And that diversity is crucial, right? You never want to rely on just one source of cash. They also manage their cash flow and borrowing schedule with incredible precision to avoid any sudden shocks. The whole thing is really a masterclass in financial management. Okay, so to execute this strategy, the Treasury has a whole toolkit of financial instruments. They don't just ask for one giant check. Instead, they offer a menu of different options, and each one is designed to appeal to different types of investors with different kinds of goals. Let's take a look inside that toolkit. The main tool in the box is something called marketable securities. The easiest way to think of these as IOUs from the government, but with a twist. They can be bought and sold freely on the open market long after the government first issues them. This ability to trade them easily is what makes the market so liquid. It means there are always buyers and sellers ready to go, and that keeps the entire system running smoothly. And this toolkit really does have something for everybody. For short-term borrowing, you've got Treasury bills. For investors who want a steady stream of income over a few years or even 30 years, there are notes and bonds. And for anyone who's worried about inflation eating away at their investment, there are special inflation-protected securities called TIPS. By offering all this variety, the Treasury makes sure it can attract the widest possible audience of investors, which, you guessed it, helps keep those borrowing costs low. Now, with all these fancy tools, you'd probably expect the Treasury to act like a slick Wall Street trader, trying to time the market to get the absolute best interest rates. But its actual strategy is the complete opposite. Because when you're borrowing trillions of dollars, boring is better. In fact, it's absolutely essential. And here's the crucial reason why. The US Treasury isn't just another player in the market. In a very real sense, it is the market. It's so huge that if it tried to make surprise, opportunistic moves, it would cause chaos. That kind of uncertainty would spook investors and, ironically, end up driving the government's borrowing costs way up in the long run. So what does the Treasury do instead? It focuses on being regular and predictable. It's like clockwork. They announce their borrowing plans way in advance, and then they stick to them no matter what. By never trying to time the market or make surprise moves, they become this incredibly reliable, steady force. And that discipline is exactly what builds bulletproof trust with investors all around the globe. And this steady, predictable strategy is the secret sauce. It creates this deep, liquid market where investors know exactly what to expect. And having that massive, stable market is precisely what allows the Treasury to fulfill its prime directive, funding the government at the least possible cost to all of us taxpayers over the long haul. Okay, so we've seen how the Treasury borrows the money, but who exactly is on the other side of that deal? Who is lending all of these trillions of dollars? The answer might surprise you. It's pretty much everyone. The group of investors is just incredibly diverse.
We're talking about foreign governments that see U.S. debt as one of the safest places on the planet to park their money. We're talking about huge pension funds and insurance companies that need super reliable long-term investments to meet their obligations. And it even includes regular folks, individual American savers buying savings bonds.
Now, this widespread global trust has a huge side effect. Because U.S. debt is seen as the safest investment in the world, its interest rate has become the global benchmark. It's like the risk-free foundation that almost every other financial asset in the world, from corporate loans to mortgages, gets priced against. And this is where it all comes home and affects you and me directly. The interest rate you pay on a mortgage or a car loan or even a student loan, it is directly influenced by the rates on these treasury securities. The health of this market literally affects the cost of borrowing money for everyone, everywhere. So, in the end, this is way more than just a story about how a government borrows money. What we're really looking at is this carefully engineered system built on predictability and trust that provides the bedrock of stability, not just for the U.S. economy, but for the entire global financial system.
Ultimately, this whole incredible globe-spanning structure is built on one simple but incredibly powerful idea: trust. The unwavering belief that the U.S. government will always, always honor its debts. That confidence is the invisible glue holding the whole thing together. Which really leaves us with one final thought. In a world full of complex markets and big numbers, what is the real bottom line value of trust?